The analysis of shares can really be broken down into two approaches: fundamental analysis and technical analysis. In this webinar, I will explain the relationship between these two approaches to share assessment. To do that, I need to ask you a question. What do you get when you buy a share? These days, your ownership of a share is simply an electronic record held by the central registry. But what financial benefit does it entitle you to? Well, firstly, you're entitled to whatever dividends the company decides to pay while you are holding the share. Then, of course, you could make a capital gain if you can sell the share for more than you paid for it. Finally, if the company is liquidated, you can get your share of the assets after all the creditors have been paid. But of course, most high-quality companies listed on the JSE have been there for decades and decades, and the probability is very low that they will be liquidated. So really it just comes down to the dividend and possibly a capital gain. If we assume that the company whose shares you buy is going to be around for a long time, like Standard Bank, then really the only benefit shareholders can get from owning its shares is the dividend. An individual share might change hands between members of the public 50 times, selling for higher and lower prices, but the only new money that can enter that group of people is the dividend. In fact, if you can sell a share for more than you paid for it, it is because the person who buys it from you has a higher perception of the future dividends of that company than you had when you bought it. In other words, a capital gain only comes about because there is a change in the perception of the company's future dividends. Or to put it another way, a capital gain is just a dividend in a different form. If you can understand this idea and accept it, you will have made a great step forward in your understanding of the share market. But if the only thing you can get from owning a share is the dividend, then it makes sense to forecast the future dividends of the company to see what you are buying. Let us look at an example. Suppose that you are looking at a particular company, ABC Limited, with a view to buying its shares on the JSE. You study its financials and perhaps visit the company to try to understand its business and get some idea of what its future flow of dividends might look like. Let's suppose that after careful assessment, you predict that next year, ABC Limited will pay a dividend of 100 cents. And let us say that you predict that the dividend in the next year, the year after that, will be 120 cents. And let's say 135 cents in year 3, 160 cents in year 4, and 185 cents in year 5. A very nice, steady growth in profitability and hence dividends. But of course, you would not be willing to pay 100 cents now for the right to receive 100 cents in a dividend in a year's time, because of inflation, the opportunity cost of your money, and so on. But you might be prepared to pay, say, 70 cents for it now. The second dividend of 120 cents, you're only getting that in 2 years' time. So you'd probably only be willing to pay, say, 55 cents for that in today's money. And then let us say you'd be willing to pay 45 cents now for the third year's 135 cent dividend, 30 cents for the fourth year, and 25 cents for the fifth year. And let us say that for all the dividends that are going to come after that, you're prepared to pay another 75 cents. If we add up all those amounts, then we come to 300 cents. And that is what the share is worth to you now, in today's money. The process of reducing a future flow of dividend incomes into today's money is called discounting. And that is probably the single most important word in the share market. You will often hear an analyst or a stockbroker saying that a certain event which impacts on the profitability of a company has or has not been discounted into its share price, has been fully discounted, has been partially discounted, or not discounted at all. What he is saying is that investors as a group have or have not taken into account this event, and they have changed the value or not changed the value of the share accordingly. In our example, your discounted cash flow of the future dividends of ABC Limited indicates to you that it is worth 300 cents now. You can compare that figure to the price that the share is selling for in the market. If it is trading for 450 cents, you will regard it as expensive, but if it is trading for 200 cents, you will consider it to be cheap and you might well buy it. But of course, this is just your forecast of the future dividends of the company. Another investor might say that he expects the company to pay a dividend of 90 cents next year, or 110 cents, or 105 cents. Everybody's different. In fact, if we did a survey of all the investors who are interested in this share right now, we might find that their discounted cash flows of the future dividends of ABC Limited varies from a high of 400 cents to a low of 200 cents. And the market price of the share at this moment could be up here or down here, depending on whether there were more optimists than pessimists or vice versa. In fact, the market price of a share is the average of all investors' discounted cash flows of the company's future dividends at any point in time. That is an important definition. The market price of a share is the average of all investors' discounted cash flows of the future dividends of a company at any point in time. Now let us suppose that we have a time machine and we can travel into the future, and we establish that our forecast of the future dividends of ABC Limited is 100% correct. When we return to the current time, we see all the other investors desperately trying to predict what the future flow of dividends will be. But we now know the truth. We know what the real value of the share is. With that thought in your head, we can define fundamental analysis as the search for the share's real value. And technical analysis can be defined as the study of investors' perceptions of the real value, as it appears in the share's price and volume pattern. So really, there are two different kinds of people out there who invest in shares. The conservative people like stockbrokers and fund managers say, we will not buy shares unless we can see the real value. And then you have other people who say, the real value of the share doesn't really matter. What matters is what people think the real value is. That's what matters. So they focus on perceptions. There's the reality and the perception of the reality, fundamental and technical analysis. You need to be very aware of what I've explained here. You need to think about it carefully. You need to internalize it, because it will become a framework onto which you can hang everything that you can learn about the stock market and the analysis of shares. But you might ask me, who has got the time to do discounted cash flows of the future dividends of a share that they are interested in? Well, in reality, only the big institutions who employ fund managers who have the time to actually do this. But if you think about it, you will realize that you are actually doing it without even realizing that you are. For example, suppose that you are considering buying a gold mining share, which is trading in the market for 100 Rand a share on Friday. And over the weekend, the price of gold drops by $25 an ounce. Come Monday morning, are you still prepared to pay 100 Rand for that share? Certainly not, because you have subconsciously adjusted your perception of the future profits and dividends of that company down, and you are now only willing to pay a lower price for its shares. This shows that you are, in effect, doing a discounted cash flow of the future dividends without even being aware of it.